In a world constantly demanding more complex tech, for AI, 5G, global electrification,
Mm.
we often get dazzled by the flashy new chips or the sleek EVs themselves.
Right.
But what about the invisible critical forces that ensure all this cutting-edge tech actually works flawlessly?
That's a great point. The behind-the-scenes stuff.
Exactly. Does a company like Teradyne, which is right at the heart of that indispensable validation process, possess the fundamental strength to be truly bulletproof? Or is the market's current caution, well, justified?
That's really the core tension we're diving into today.
Welcome to the Deep Dive, where we unpack complex topics and distill surprising insights just for you.
Absolutely. Today, our focus is squarely on Teradyne,
Yeah.
Inc. They trade on the NASDAQ, ticker TER.
Right, TR. And this is a company that, frankly, is an unseen but vital backbone of the whole high-tech manufacturing world.
Definitely. They specialize in automated test equipment and industrial automation.
And this deep dive is incredibly timely, isn't it?
It really is. We're analyzing Teradyne as of July 29, 2025. The share price was $90.15 just a few days back on the 25th.
And the critical point here.
The critical point is that Teradyne is scheduled to release its Q2 2025 financial results today, July 29th, after the market closes.
Ah, so hot off the press, potentially.
Exactly. And then there's a management conference call tomorrow morning, July 30th.
Okay. And Wall Street, for its part, they seem pretty cautious about this quarter.
Decidedly muted expectations, yes. Analysts are forecasting a significant year-over-year contraction.
How significant are we talking?
Well, revenue is expected between, say, $646 million and $651 million. That's about an 11% drop year over year.
Okay, that's quite a dip. And earnings?
And non-GAAP EPS, that's the earnings figure Wall Street often focuses on, adjusted for certain items, is projected at just 54 cents.
Wow, 7.54 cents. That sounds like a steep drop.
It is. It's a steep 37% decline compared to last year. This reflects, persistent macroeconomic uncertainty, specific weaknesses in memory and mobile test systems, and also their own guidance for squeezed profit margins.
So a challenging picture, but there's a twist, right?
There is. What's fascinating here is Teradyne's track record. They have a consistent pattern of, outperforming these low expectations.
Really? How consistent?
They've surpassed consensus EPS estimates in each of the last 4 quarters.
Okay.
And the average positive surprise was over 14%. So yeah, it sets a really complex and intriguing stage for today's announcement.
It certainly does. And just for you listening, here at the Deep Dive, we'll actually be covering their actual earnings results within minutes of their release.
That's right. Immediate analysis coming your way, so stay tuned for that.
Definitely. So to help you understand this intricate picture, we've structured this deep dive into 2 main parts.
First, we'll look at the company's foundations,
Hmm.
the business itself, the management team, and the financials.
Right, the core stuff.
Then we'll shift to the external dynamics. Think market sentiment, who owns the stock, key risks.
And finally, we'll bring it all together in our conclusion. Sound good?
Let's do it.
All right. Let's jump right in with Chapter 1, Business Analysis, the engine of innovation. To kick things off, for anyone who might not be super familiar, what exactly does Teradyne do?
Okay, at its core, Teradyne designs, develops, manufactures, and sells high-precision automated test equipment. People usually call it AE.
Got it.
And also industrial automation or IA solutions. They do this globally.
So testing and automation, why is that so important?
Well, imagine every complex microchip or electronic system in your life, your phone, an AI server, whatever, being built without a final critical quality check.
Chaos, basically.
Exactly.
Yeah.
That's the chaos Teradyne prevents. Their solutions aren't just a nice to have. They're kind of the invisible, indispensable audit firm that guarantees performance. They slash costly failures, and they dramatically speed up a product's journey to market.
So where does their revenue come from just selling these machines?
Mostly from direct sales of these complex systems, yes. But there's also a strategically important and growing stream from services and recurring software licenses.
Ugh.
Recurring revenue. Always good.
Especially relevant in their robotics segment, which we'll touch on.
Okay, so they're not just selling hardware. They've smartly built in that growing recurring stream. What are the key products and segments that make up the business?
They basically structure operations around 4 main pillars. The first, and the largest by far, is semiconductor test.
Okay, testing chips.
Right. This segment provides for a huge array of chips. Think system on a chip, so that's like an entire electronic system packed onto one chip.
Like in smartphones.
Exactly. And memory types like DRAM and flash. They're big product families. You might hear names like J750, FOX, Ultra FLX. These are absolutely critical for chip makers to validate performance, ensure quality, and importantly, optimize their manufacturing yields. Get more good chips out the door.
So if I'm understanding this right, without Teradyne or companies like them, these complex chips just wouldn't make it to market reliably.
That's pretty much the fundamental truth, yeah. They're the quality control gatekeepers for a huge chunk of the semiconductor industry. Okay, what's the second pillar?
Then there's system test. This offers solutions for testing more complex electronic systems and circuit boards.
So bigger things than just individual chips.
Right. Think high-stakes industries like defense and aerospace or data storage systems, the really intricate stuff.
Like the mission-critical systems in a fighter jet or a massive data center.
Precisely. Reliability is paramount there. Third, they have wireless tests, mostly through their subsidiary called LightPoint.
LightPoint, okay. What do they test?
They specialize in testing wireless connectivity. So everything from smartphones and tablets to PCs and all those Internet of Things or IoT devices, Wi-Fi, Bluetooth, 5G.
Makes sense. Everything's wireless now. And the fourth pillar?
And finally, a really strategic diversification for them, robotics.
Ah, robots. Always interesting.
Yeah. This segment features universal robots. They make collaborative robots or cobots.
Cobots.
Oh, yeah.
Those are the ones designed to work safely alongside humans, right?
Exactly, not caged off in a separate area. And they also have mobile industrial robots, or MIR, which make autonomous mobile robots for automating tasks in manufacturing and logistics. Think automated carts moving things around a factory or warehouse.
That's quite a range. Semiconductor tests, system tests, wireless, and robotics. So given this broad portfolio, where does Teradyne actually stand in the market? Big fish, small pond?
Oh, they're absolutely a global leader in the ATE market. They hold a dominant position.
Phenomenal, okay.
And they partner with pretty much every major semiconductor manufacturer worldwide.
Wow.
And this isn't just reputation. It translates directly into strong margins and significant market share across North America, Asia, and Europe. They're a true global player.
That makes perfect sense. Now, you mentioned earlier the semiconductor market is cyclical, ups and downs.
Very cyclical, yes.
But you also mentioned powerful secular trends, long-term shifts.
Right.
What are these megatrends Teradyne is trying to capitalize on for future growth?
Yeah, this is key. CEO Greg Smith often highlights three critical trends. First, the rise of AI-oriented, vertically integrated customers. Meaning, think big tech companies, the Googles, the Apples, the Amazons, designing their own custom silicon, their own chips in-house.
Ah, right. That's a huge shift.
It is. Second, global electrification. This is driving massive innovation in power semiconductors, for EVs, renewable energy infrastructure, power grids.
Okay.
And third, just the pervasive application of AI everywhere. Not just in the cloud, but also at the edge in devices like your smartphone, smart cameras, industrial sensors.
And how does this help Teradyne?
Well, all of these trends fundamentally increase chip complexity, dramatically in many cases.
And more complexity means?
More complexity directly fuels the need for more sophisticated, more powerful testing solutions. It's a direct link.
Okay, so it sounds like a pretty good market to be in, despite the cycles. What's the competitive landscape like? Is it easy for others to jump in?
It sounds like a protected market then.
Very much so. The ATE market is essentially an oligopoly. There are really formidable barriers to entry.
Like what?
Well, we're talking intense, sustained R&D investment. You need deep pockets and long-term commitment. Then there are these deeply integrated customer relationships. They often involve co-development years in advance of a product launch. Switching costs for manufacturers are prohibitive. It's not like changing coffee suppliers.
Right, you can't just swap out your multi-million-dollar test equipment easily.
Nah, not at all. And finally, decades of accumulated intellectual property, patents. It's a tough moat to breach. Teradyne's primary competitor, especially in semiconductor test, is Advantest.
Advantest. Okay, so it's mainly those two big players.
In the high-end semiconductor test space, yes, they're the dominant forces. It's a tight race.
So what really makes up Teradyne's competitive moat? What gives them that enduring edge?
Several key things contribute. First, just sheer brand strength. Founded way back in 1960 by some MIT classmates.
Wow, 1960. That's ancient in tech terms. It really is. And the Teradyne brand is synonymous with quality, reliability, technological leadership. That trust is built over 6 decades. It's rare for a tech company to not just survive, but thrive for that long.
True. What else?
Then there are significant economies of scale. Being a large player gives them advantages in procurement, manufacturing, logistics, the usual stuff.
Right.
But crucially, they can spread their substantial R&D costs over a much larger revenue base. This lets them maintain what they call a durable and profitable operating model, even during industry downturns when smaller players might struggle to keep investing.
Right, so they're big enough to weather the storms and keep innovating, which reinforces their lead. Makes sense.
Exactly. And the high switching costs we mentioned are huge.
Yeah.
Customers get deeply embedded in Teradyne's ecosystem. The cost, the time, the disruption involved in switching to a competitor are just immense for a chip fab.
So a very sticky customer base.
Extremely sticky. Once a chip maker is integrated with Teradyne, yeah, it's like rebuilding a core part of their factory just to switch test providers.
Okay. Any other advantages?
Finally, I'd say their unique end-to-end solutions are a key differentiator. They can provide comprehensive test solutions across the entire electronics value chain.
Meaning from the very beginning to the very end.
Pretty much. From the raw silicon wafer level through packaging, right up to testing the final product. This is especially valuable for those vertically integrated tech giants designing their own custom chips. Teradyne can partner with them throughout that entire complex development lifecycle.
That end-to-end capability sounds powerful. Okay, let's shift focus now and look at the people running the company. We'll move on to Chapter 2, Management Evaluation, Stewards of Capital. How's the leadership looking at Teradyne? Experienced. New blood.
The leadership seems to be in very experienced hands. The president and CEO is Greg Smith. He was promoted from within back in February 2023, so relatively new in the top spot, but he's a company veteran.
Ah, an insider. Does he have a good track record?
A very impressive one, actually. Before becoming CEO, he grew the industrial automation revenue, that robotics segment, by a hefty 44% between 2020 and 2023.
Okay, significant growth there.
And before that, he oversaw over 50% growth in the much larger semiconductor test division. His entire career, basically, has been dedicated to test equipment.
So deep domain expertise, that's valuable.
Invaluable, I'd say. And the management team as a whole really emphasizes that durable operating model concept we talked about, protecting R&D during downturns. It really reflects disciplined, forward-thinking leadership.
That internal promotion and the focus on R&D stability does sound like a smart long-term play. How important is that disciplined approach compared to maybe competitors?
I think it's a significant differentiator. It allows them to maintain their technological edge even when revenues dip, ensuring they're ready, maybe even ahead, for the next inevitable upturn.
Right. What about communication and ethics? How do they score there?
They put a strong emphasis, publicly at least, on ethical business practices and transparency. It's formalized in their code of conduct.
Standard corporate stuff?
While they highlight core values like honesty and integrity, a company without doors, which sounds like an open-door policy for communication, and customers count on us.
Okay. Do they back that up with actions?
Seems so. They have concrete governance mechanisms, like an anonymous whistleblower hotline and mandatory annual training for employees covering things like anti-bribery and anti-corruption. Standard, yes, but important boxes to tick.
Good to hear. So let's talk capital allocation. How do they decide where to put their money, investing back in the business versus giving it to shareholders?
Their capital allocation strategy seems pretty multifaceted and has a long, apparently successful history. They focused on prudent, strategic, bolt-on acquisitions.
Bolt-ons, meaning smaller, targeted acquisitions.
Exactly, to enter specific high-growth markets. Key examples include Quantify Photonics, just this year, 2025, for silicon photonics testing.
Ah, cutting edge.
Universal Robots back in 2015 for those cobots. LightPoint in 2011 for wireless test. Even earlier acquisitions in 2008 boosted their core semiconductor test business.
So a history of buying into new tech areas, do they sell things too?
They do. They also strategically divest non-core assets. They sold their device interface solutions business in 2023, for instance. It shows a disciplined approach to managing their portfolio, not just accumulating businesses.
It sounds like they're actively shaping the company through M&A. What about returning capital directly to shareholders?
Well,
buybacks, dividends?
They're very active there, too. A new $1 billion share repurchase authorization was just approved in Q1 of this year, 2025.
$1 billion. That's substantial.
It is. And just last fiscal year, 2024, they returned $275 million to shareholders through buybacks and dividends. That was a hefty 58% of their free cash flow.
Wow, over half their free cash flow back to shareholders.
Yeah. And they have a well-established dividend program, too. They've paid a dividend for 12 consecutive years now, with 2 consecutive years of actual dividend growth. And the payout ratio, the percentage of earnings paid out as dividends, is very sustainable, around 13–14%.
That's a healthy return profile. So how do we actually measure the effectiveness of all this? Buying companies, buying back stock? Are they making smart choices? What's the proof?
Well, the ultimate measure arguably, is their return on invested capital, ROIC. How much profit are they generating from the capital they invest?
Right. And how does Teradyne look?
They consistently generate strong returns. Recent data shows an ROIC of about 13.65%. There's also ROCE, return on capital employed, which is slightly different, looking at all capital that's sitting at 19.67%.
Pretty good numbers.
Very solid. And historically, during the peak cycle years, these figures have often shot up past 20%, sometimes even exceeding 40%.
40% ROIC, that's impressive.
It really is. It confirms that their investments, by and large, are being skillfully managed and are genuinely adding value. They're not just spending money, they're getting good returns on it.
Okay, that provides good context on management. Now let's really turn to the numbers themselves. We'll dive into Chapter 3, Financial Analysis, a quantitative deep dive. What do the financials tell us overall about Teradyne's health and resilience?
The financials paint a picture of a company with, as we said, cyclical revenue. That's just the nature of the semiconductor equipment beast.
Right, comes with the territory.
But, crucially, they also show consistently high profitability through those cycles, strong cash flow generation, and a, frankly, remarkably robust balance sheet.
Okay, let's get specific. Market cap.
As of July 25th, market cap was hovering around $14.6 billion.
And revenue trends over, say, the last 5 years? You mentioned cyclical.
Yeah, the cycle is starkly clear. Revenue surged from about $3.1 billion in 2020 up to a peak of $3.7 billion in 2021.
Okay, big upswing.
Then the downturn hit. It declined to $2.68 billion in 2023, but then it showed a 5% recovery in 2024, back up to $2.82 billion.
So they definitely feel the swings, but they seem to rebound. How did their profit margins hold up during all this volatility? Is profitability consistent, or does it swing wildly too?
Well, despite that revenue volatility, their profitability is exceptionally strong and, I'd say, resilient. Gross margins consistently hover in the high 50s% range.
High 50s gross margin, that's very healthy.
Very healthy. It even peaked near 60% sometimes. Operating margins are naturally more sensitive to volume changes.
Sure.
But they remained robust. Non-GAAP operating margin was still above 20% in 2024, even after the downturn, and at the 2021 peak, an impressive 32.7%.
Wow, nearly a third of revenue dropping to operating profit at the peak. Okay, what about free cash flow? Cash is king, right?
Absolutely. And Teradyne is a prolific free cash flow generator.
Wow.
They generated $474 million in FCF in 2024.
Okay.
And $97.6 million just in Q1 of 2025, which was actually a positive reversal from a cash burn the same quarter the previous year.
So consistently throwing off cash.
Yes. And this consistent cash generation is exactly what fuels those capital return programs, the buybacks and dividends, and gives them significant financial flexibility for things like M&A or weathering downturns.
That paints a picture of a financially sound company, definitely. So the big question, is it a value at its current price? Let's talk valuation. How does it look compared to its history?
Okay, looking at relative valuation first. With the share price around $90.15 and their trailing 12-month EPS, TTM EPS, at $3.58, that gives a price-to-earnings, or PE, ratio of about 25.2.
25.2, how does that compare?
Well, it's slightly below its 10-year historical average PE, which is 26.0, and it's significantly below its more recent 3-year average of 31.7.
So maybe a bit cheaper than usual.
It suggests a potential discount relative to its own history, yes.
Ah.
But, and this is a big but, we have to consider that the market is currently expecting that near-term earnings decline we talked about. The PE is based on past earnings.
Right, the denominator might shrink soon. What about looking at intrinsic value, trying to figure out what the company is really worth based on future cash flows, using a discounted cash flow or DCF model?
Yeah, a DCF analysis tries to do just that. It estimates intrinsic value by projecting future free cash flows and then discounting them back to their present value, accounting for the time value of money and the riskiness of those cash flows.
Okay. And what does a reasonable DCF model suggest for Teradyne?
Based on what I think are reasonable, fairly conservative assumptions.
Such as?
Specifically, assuming 10% annual free cash flow growth for the next 5 years, which is roughly aligned with current analyst forecasts for the recovery phase, and then a pretty conservative 2.5% perpetual growth rate forever after.
Okay, like long-term economic growth.
Exactly. And discounting those cash flows back
Right.
using a 9.0% weighted average cost of capital, or WACC, that's basically the required return for investors.
Got it.
Our educational DCF model suggests an intrinsic value range for Teradyne stock of $95 to $115 per share.
95 to 115. Okay, so comparing that to the current price of around $90.
Right. The current market price appears to be pricing in a more severe or perhaps more prolonged downturn than what longer-term forecasts and management's own outlook seem to suggest.
Interesting. So this disconnect could potentially signal an opportunity for investors who can look past the immediate headwinds and focus on that longer-term intrinsic value.
That's often where value investors find opportunities, yes, when near-term sentiment diverges significantly from potential long-term value.
Okay, that's a great overview of the company itself. Let's shift gears now to part 2, external dynamics and outlook. We'll start with chapter 4, market sentiment, gauging the narrative. What's the general vibe from Wall Street analysts on Teradyne? Bullish, bearish, confused?
Confused might be part of it. Wall Street analysts show, well, significant uncertainty. The overall consensus rating is generally a moderate buy or buy.
Okay, sounds positive enough.
But that average masks a really wide dispersion of opinions. You've got price targets ranging from a pretty bearish $69 to $74 from firms like Morgan Stanley and Goldman Sachs.
Oof, that's way below current levels.
All the way up to a strikingly bullish $133.20 to $139 from Susquehanna.
Wow, that's almost a double from the bears. Quite a spread.
It really is. The average and median targets cluster around $98 to $102. That suggests only a modest 9% to 13% upside from the current $90 price. So, yeah, lack of strong conviction is probably the fairest assessment.
Yeah, a divided street. What's the general media tone? Is the narrative optimistic or cautious? And how has recent news hit the stock?
The financial media narrative is largely cautious right now. The focus is very much on the semiconductor downturn, the headwinds in memory test, mobile test, all the challenges, and the market sensitivity. Crystal clear back in April 2025. Teradyne actually beat Q1 expectations, but the stock went down.
Beat is good, right?
Normally, yes, but it declined simply because management didn't reaffirm guidance beyond Q2. They only guided one quarter out.
And the market read that as
low visibility, lingering uncertainty. If things were clearly getting better, why not guide further out? That was the interpretation.
got it. How about other market indicators, like short interest? Are lots of people betting against the stock?
Short interest is, I'd say, moderate. It's running at about 4.3% to 5.0% of the public float. That's the percentage of shares available for trading that are sold short.
Is that high or low?
It's not exceptionally high, no. And the days to cover ratio, how many days of average trading volume it would take for all shorts to cover their positions, is quite low, only 1.7 to 2.0 days.
Meaning
Short positions could likely be covered relatively easily without causing a major short squeeze, where forced buying pushes the price up rapidly.
Okay, so moderate short interest. What about the technical trends, the charts?
Technically, the stock looks weak right now. It's trading below its 50-day simple moving average, which is around $92.69. That indicates negative short-term momentum.
Below the 50-day and longer term.
It's also below its 200-day simple moving average, which is somewhere between $91.33 and $102.20, depending on the exact calculation date.
Right.
It's definitely below.
That confirms a longer-term downtrend is currently in place.
It seems the technical picture, trading below those key moving averages, is really just echoing this fundamental narrative of uncertainty, doesn't it?
It absolutely does. The stock is technically weak because its outlook is so contested right now, which, again, makes today's earnings report such a critical potential catalyst. It could confirm the weakness or maybe signal a turn.
Right. All eyes on the results later today. Okay, let's dive into Chapter 5, ownership structure. Who actually owns Teradyne stock? Is it mostly big institutions, or do individual investors play a big role?
It's overwhelmingly dominated by institutional investors. They hold approximately 97.3% to 97.6% of all the shares outstanding.
Wow, 97% plus. That's huge. Who are the big holders? Mostly the usual suspects, the giants. Major index fund providers like the Vanguard Group, they hold about 13.0%. BlackRock has around 10.2%. Then you have FMR LLC, which is Fidelity, with 4.6%, and State Street Global Advisors at 4.4%.
So the big indexers and active managers.
Exactly. In fact, the top 25 institutions combined own nearly 64% of the entire company.
Does that provide stability?
Generally, yes. High institutional ownership, especially from large, long-term oriented funds, tends to provide a stable shareholder base, less prone to panic selling on short-term news.
What about insiders, the executives, the directors? Are they holding much stock? Buying, selling?
Direct ownership by company insiders is actually relatively low. It's only about 0.32% of the company.
Less than 0.5%. What about their trading activity?
Well, if you look at recent transactions, you'll see a pattern of selling activity. However,
Overselling isn't usually seen as a good sign.
true. But context is key here. The vast majority of these sales are flagged as planned sales under prearranged SEC Rule 10b5-1 trading plans.
Okay, what does that mean?
It means these sales were scheduled well in advance. There's standard practice for executives to manage their compensation, diversify their holdings, handle tax liabilities, that sort of thing. It doesn't necessarily signal lack of confidence about the company's immediate prospects.
So it's more about personal financial planning than a market call.
Largely, yes. You also see regular acquisition, non-open market transactions, which are basically formal stock awards, part of their compensation packages.
Right. So executive incentives are still aligned through owning stock, even if they sell some periodically.
Exactly. Their incentives are primarily aligned through ongoing equity-based compensation. Honestly, a shift in sentiment or a large sale by one of those major institutional holders would probably be a more significant signal than these routine insider sales.
That makes sense. And the high concentration among those top institutions.
It creates that stable, long-term oriented shareholder base we mentioned. They're less likely to be swayed by short-term volatility, especially with huge passive funds like Vanguard and BlackRock holding anchor positions.
Got it. Okay, now for a comprehensive look at the challenges and opportunities ahead. Let's cover Chapter 6, Risk Assessment, a 360-degree view. Let's break down Teradyne's strengths, weaknesses, opportunities, and threats. The classic SWOT analysis. What are the core strengths?
Okay, strengths. We've touched on most of these. Dominant market leadership, that strong brand reputation built over 60-plus years, deep technological expertise, and those really crucial high switching costs logging in customers. Plus, a very strong balance sheet, low debt, high free cash flow generation, and that experienced, disciplined management team, solid internal foundations.
And the flip side, the internal weaknesses. Every company has them.
Absolutely. Historically, a key weakness has been high customer concentration. Relying heavily on a few very large clients can be risky if one pulls back spending.
Right. Eggs in too few baskets.
Kind of. And of course, that significant exposure to the boom and bust semiconductor capital expenditure cycles, that's just inherent to the business model.
And the robotics segment.
Right. While it's positioned as a key long-term growth driver, the robotics segment is currently less profitable than the core test business, and it's quite susceptible to weakness in the broader industrial economy. So it's a potential weakness in the short to medium term.
Trying to understand this whole chip supply chain sometimes feels like trying to untangle a box of old holiday lights, you know?
That's a good analogy.
And Teradyne seems to be holding a lot of those key strands, which is a strength, but maybe also makes them vulnerable if one part gets snagged.
That's a fair point. Their critical position also creates exposure. Okay, moving to opportunities. Where can they grow? Looking ahead, what's the upside potential?
They are perfectly positioned, really, to benefit from those powerful secular growth trends we discussed earlier. AI, 5G, IoT, vehicle electrification.
Right.
The increasing complexity of chips driven by all these trends directly demands more sophisticated testing solutions. That's their bread and butter.
And the industrial automation market.
Also a huge opportunity. It's still a large market that's relatively underpenetrated by automation, especially cobots and mobile robots. Lots of room for expansion for their universal robots and MiLAR businesses.
Okay, sounds promising. Now, the scary part, threats. What external factors could really derail their progress?
Well, number one is those inherent boom and bust cycles in the semiconductor industry. They just have to ride those waves. Intense competition.
Yes, intense competition, primarily from advantists, keeps them on their toes. Macroeconomic downturns are a major threat. Recessions reduce customer capital expenditures, hitting Teradyne directly.
And geopolitics. Trade wars.
Huge potential threat. Geopolitical tensions and trade restrictions, think tariffs, export controls, particularly between the U.S. and China, are a major risk.
How so?
They can disrupt the global electronics component supply chain, increase costs, create uncertainty, all things that make customers delay buying expensive equipment.
Okay, let's dig into those macro and geopolitical risks a bit more. How do things like elevated interest rates and inflation impact a company like Teradyne right now?
They pose a very direct threat. Higher interest rates and persistent inflation can dampen overall global economic growth.
Which means
Teradyne's customers might face a higher cost of capital, making them more cautious about big investments. They might delay or reduce spending on new test equipment. This dynamic is really a primary driver of the current cyclical downturn they're experiencing.
Makes sense. And specifically on those geopolitical factors, say the ongoing trade tensions between the U.S. and China, How might something like new tariffs affect them?
Geopolitical risk is absolutely central. A hypothetical, say, U.S.-imposed tariff of 2025 could directly increase their component costs or force them to raise product prices, potentially hurting demand.
Okay, direct cost impact.
But perhaps more significantly, broad tariffs and especially export controls on advanced technology can severely disrupt that incredibly intricate global semiconductor supply chain.
Creating uncertainty again.
Exactly. Uncertainty is the enemy of capital investment. Customers delay decisions when they don't know what the rules will be. Teradyne's indispensable role in advanced semiconductor production makes it particularly vulnerable to being caught in the crossfire of these trade disputes. They are, as you suggested, a vital but potentially exposed cog in a very complex global machine.
A vital but exposed cog. That captures it well. Okay, let's try to bring all these threads together now in Chapter 7. Conclusion. Let's start by synthesizing everything into the bull case for Teradyne. What are the strongest arguments for being optimistic, maybe for investing for the long term?
Okay, the bull case rests on several really strong pillars, I think. First, that durable competitive moat. It's built on decades of tech leadership, a trusted brand, deep customer integration, high switching costs. It's real.
Right, the moat seems solid.
Second, they benefit from those powerful secular tailwinds, AI, 5G, IoT, electrification. These aren't fads. They're fundamental shifts driving demand for complex testing.
They're riding some big waves.
Third, the financial fortress. Pristine balance sheet, robust free cash flow, history of high returns on invested capital. The financial foundation is strong.
Okay.
Fourth, disciplined capital allocation. Management has a clear, effective strategy. Reinvest for growth via smart acquisitions and consistently return significant cash to shareholders through dividends and buybacks.
Shareholder friendly.
Very. And finally, the potentially attractive valuation. Trading below recent historical averages suggests the market's current focus on near-term cyclical pain might be creating an attractive entry point for long-term investors.
That's a very compelling bull case, especially if you have a long time horizon. But as we discussed, Wall Street seems pretty cautious right now. The stock's technically weak. What's the biggest crack in that bull case? Let's outline the bear arguments.
Okay, the bear case. It primarily centers on the severe cyclical headwinds they're facing right now. The core semiconductor market is in a pronounced downturn. Forecasts show significant revenue and earnings declines, and there's genuinely limited visibility on the timing of a recovery.
So near-term pain is real.
Very real. Tied to that is near-term margin pressure. Management themselves have guided for lower gross margins due to product mix shifts and just lower sales volumes overall.
What about robotics?
That's another point. Uncertainty in robotics. It's meant to be a key long-term diversification, but it's currently underperforming due to the weak global industrial economy. Its path to significant scale and profitability is still somewhat of a question mark.
Okay.
And then those geopolitical and trade risks we just talked about. As a critical enabler of the global semiconductor supply chain, Teradyne is increasingly exposed to tensions, tariffs, export controls, things largely outside their control that can materially impact operations.
Big external risks.
And finally, just the current negative market sentiment and technicals. The stock is in a clear technical downtrend, trading below key moving averages, and analysts, as we saw, have a very wide dispersion of opinions. The market isn't convinced yet.
Okay, bull case, bear case. Pulling it all together, what did our valuation analysis suggest about Teradyne's price versus its potential intrinsic value?
All right, our educational discounted cash flow analysis, based on those reasonable assumptions, suggested an intrinsic value range for Teradyne stock of $95 to $115 per share.
95 to 115, and the stock is currently around 90. So what does this all mean for you, our listener, trying to make sense of all these moving parts?
Well, Teradyne's current share price of $90.15 is trading slightly below the low end of that estimated intrinsic value range.
Okay.
This suggests the market is heavily discounting the company's long-term prospects right now. It seems to be pricing in a significant degree of pessimism about this current cyclical downturn, perhaps more than the long-term fundamentals warrant.
So for a certain type of investor.
So for you, the long-term investor, someone who could look past this near-term volatility, the current price may represent a compelling opportunity. You could potentially acquire a high-quality, market-leading business at a reasonable valuation, supported by those powerful secular growth trends, strong financials, and shareholder-friendly management.
But it's not without risk, especially short-term.
Absolutely not. For you, the shorter-term investor, or someone more risk-averse right now, considerable uncertainty remains. You've got the prevailing bearish sentiment, the negative technical trends, and the company's own warnings of a potentially difficult quarter coming up.
And today's earnings report is key.
Today's Q2 2025 earnings report will be a absolutely critical catalyst. It's going to provide crucial data points that could either validate the market's current caution, confirming the bears,
Oh,
or perhaps signal that the cyclical bottom is near, potentially paving the way for a recovery and rewarding the bulls.
it really feels like an inflection point.
It could be. So, as we wrap up this deep dive, here's something to chew on. Consider how Teradyne's indispensability in the complex world of cutting-edge technology
Mm,
also, paradoxically, places it squarely in the path of these major global economic and geopolitical storms.
right, strength and vulnerability intertwined.
Exactly. Can its core strengths, the moat, the tech, the finances, truly provide an impenetrable shield against these powerful external forces? Or are we perhaps witnessing a more fundamental reevaluation of its long-term trajectory? It's really a question of resilience versus exposure.
Resilience versus exposure, a great way to frame it. What a deep dive. We've really unpacked a lot here today, from the nuts and bolts of chip testing to the huge global currents affecting a company like
A
Teradyne.
complex picture for sure.
Our goal, as always, is to provide you with those essential nuggets of knowledge and insight, helping you get well-informed quickly and thoroughly on these important topics.
And just a reminder for everyone listening, this analysis was generated by an AI system purely for educational purposes. It should absolutely not be considered financial advice.
That's crucial. Please conduct your own research or consult with a qualified financial advisor before making any investment decisions based on this or anything else you hear.
Definitely.
And hey, if you found this valuable, don't forget to like and subscribe to the Stock Analytics AI YouTube channel.
Yeah, and for just $4.99 a month, members get priority deep dives on tickers. We're actually planning to cover all of the S&P 500 stocks over the next few months, and members get exclusive priority access to suggest and vote on which ones come next.
That's right. And if you just want a one-off deep dive on a specific stock you're interested in, just drop us a super thanks on YouTube.
We appreciate the support. Thank you for joining us on this deep dive. We look forward to exploring another fascinating topic with you soon.